You wake up, check your phone, and see a number, your bank balance. It looks calm, stable, almost boring. But that number only exists because a long, invisible chain is holding it up. If one link snaps, the number doesn't slowly fade. It vanishes. Here's the uncomfortable truth most people never hear. Your money is not just yours. It's a shared belief system between banks, governments, and everyone else who hasn't checked yet. And right now, that system is under more stress than it looks. This matters now because we're living through a strange moment. Markets are rising, governments are spending, banks say they're well capitalized. And yet, behind the scenes, debt levels are higher than ever, trust is thinner than it sounds, and the system is running on promises stacked on top of promises. To understand why this matters to you, we need to follow the chain, quietly, from the inside out. Start with the simplest idea you were taught. You put money in a bank, the bank keeps it safe. You withdraw it later. That story is comforting. It's also mostly false. When you deposit money in a bank, it doesn't sit in a vault with your name on it. Legally and practically, the bank now owns that money. You own a claim on the bank. In other words, your money is actually the bank's debt to you. That sounds alarming, but it's not a secret. It's the foundation of modern banking. Banks take deposits and lend them out. Not dollar for dollar, but many times over, this is how credit is created. And credit is the real fuel of the economy, not cash. Every mortgage, business loan, credit card swipe, and government bond starts the same way. A bank creates a liability and someone else agrees to believe it has value. Now zoom out one level. Banks don't just lend to people, they lend to governments. When governments run deficits, which is almost always, they issue bonds, banks buy those bonds. So do pension funds, insurers, and central banks. On paper, government debt looks safe. It's backed by the state, it's risk-free. But here's the first uncomfortable mechanism. Governments don't pay back debt the way households do. They roll it. Old debt is paid with new debt. Interest is covered by future promises. And banks are happy to play along because government bonds are treated as high-quality assets. This creates a loop. Banks hold government debt. Governments rely on banks to fund spending, and both assume the other will always be there. Now add the third link. Your pension fund owns bank stocks and government bonds. Your insurance policy is invested in government debt. Your savings sit inside a bank that depends on government stability. You're not outside the system. You are the system. This is where the chain becomes invisible. When a bank buys government bonds, it's not using its own money. It's using deposits. Your deposits. When a government rescues a bank, it's not using abstract funds. It's using future tax revenue, your future work. Everyone is lending to everyone else. And the only thing holding it together is confidence. That confidence is carefully managed. Banks publish capital ratios. Governments publish growth forecasts. Central banks publish statements filled with calm language and deliberate ambiguity. The message is always the same. The system is stable, trust it. But stability in finance doesn't mean safe. It means not broken yet. Here's where the math quietly intrudes. Global debt, public and private combined, is now several times larger than global economic output. That's not inherently a problem. Until interest rates rise or growth slows or confidence cracks, because debt only works if tomorrow is bigger than today. Now look at incentives. Banks earn profits by expanding credit. Governments stay popular by spending without raising taxes too much. Voters like benefits now and costs later. No one is rewarded for restraint. Everyone is rewarded for extending the chain. And the longer the chain grows, the more fragile it becomes. This is where public perception diverges sharply from reality. The public debate focuses on inflation, interest rates, and market indices. Those are surface-level signals. Underneath, the real question is simpler and more dangerous. Can this system keep rolling its promises forward without breaking trust? History suggests the answer is always yes, until suddenly it isn't. When things go wrong, they rarely look dramatic at first. It starts with a liquidity problem. A bank can't access short-term funding. A government struggles to auction bonds. A central bank steps in temporarily. Temporary measures have a habit of becoming permanent. During crises, the invisible chain becomes visible for a moment. Governments guarantee deposits. Central banks create money. Losses are socialized, then calm returns, and the chain disappears again. Here's the irony. The system survives by becoming more complex, more opaque, and more dependent on intervention. Every rescue teaches markets that the chain will be protected, which encourages more risk, which stretches the chain further. From the outside, this looks like stability. From the inside, it's tension management. Now consider the long-term implication. As debt grows, governments become more sensitive to interest rates. Banks become more sensitive to government credibility. Central banks become more political, whether they admit it or not. Policy stops being about optimization. It becomes about preventing collapse. At that point, choices narrow. Higher inflation quietly reduces debt burdens but erodes purchasing power. Financial repression keeps rates low but distorts markets. Currency debasement spreads pain broadly instead of concentrating it. None of these feel like default, but economically, they function like one. And the average person experiences this not as a crisis, but as a slow loss of control. Savings don't go as far. Housing becomes harder to afford. Risk is pushed onto individuals who never agreed to carry it, all while being told the system is working. This is the final uncomfortable insight. The invisible chain isn't designed to protect you. It's designed to prevent immediate failure. Your role in the system is passive. Your exposure is not. You don't get a vote on how much debt is issued. You don't approve the risk models. You don't sit in the emergency meetings, but you absorb the consequences. And as long as confidence holds, the system keeps moving quietly, efficiently, precariously. So here's the question that doesn't get asked often enough. In a world built on interconnected promises, what happens when trust becomes the scarcest asset of all? Because when the invisible chain is all that's holding things together, the most dangerous moment isn't when it breaks. It's when everyone realizes how thin it always was.